Welcome to the Money Tree Real Estate Investor Podcast, where we learn from real estate professionals across the industry. They will share about how they got into real estate, the big wins they have celebrated, the mistakes they have made along the way, and the advice they have for anyone following in their footsteps. Money really does grow on trees. Hey everybody, it's William Hollins here on another episode of the Money Tree Real Estate Investor Podcast. I've got David Cruz-Palmer with me today. He started off as a broker and eventually found his way into the industrial syndication realm. I'll let him introduce himself and just tell us a little bit more about your story, man.
Yeah, great. Thanks for having me. As you mentioned, I was a broker for about 15 years. I was with a company called Savills most recently and Cushman-Wakefield before that. And I helped commercial tenants find office space and industrial space and figure out real estate plans so that they could, do expansions. A lot of the companies that I worked with were tech companies. And a lot of them had to figure out some pretty comprehensive expansion plans and figure out where are we going to put our employees, where are we going to, put our products and evaluate the markets. And then kind of around the time COVID happened, I one of the dreams of being a commercial broker is to own your own real estate one day. And COVID sort of slowed everything down, and I had a moment and some time to think and figure out how to do that, go from the broker side to the principal side. So since then, I've syndicated 3 properties. I've raised a little over $5 million in the last year, and looking to do a lot more.
It's awesome. Yeah, I'm kind of in the same boat. So I had ankle surgery this year, and
For some people it's COVID, and for others it's ankle surgery.
Yeah, I love basketball, but basketball doesn't left me back. I've had ankle surgery and shoulder surgery so far, but that was a blessing in disguise because, it's bedridden for 2 months straight, and being an engineer and liking real estate and liking people, like I couldn't just sit there and be still. And so that gave me time to really plan and network and find the right people to start my own real estate journey. It was good.
Yeah, that's great.
Yes, sir.
Yeah.
So go ahead.
Yeah, no, I think that's amazing. I think, we all find our thing, and you just got to kind of grab hold of it and run with it and see where it takes you.
So, yes, sir. So I know you talk about industrial and triple net leases. So what value do you see in those, and why are you gearing towards that direction?
Yeah, great question. The reason I chose industrial and triple net is triple net's a lease structure that is common for industrial properties and retail properties. And what triple net is basically their expenses. So you can imagine if you own an industrial building, it's on some land, there's a building with some walls and a roof, and there's like a parking lot, and a tenant comes in. You can imagine, say 50, 60 years ago. You say, I own this building, and the tenant says, well, I want to come in. You're like, what do you want to do there? And it's like, I want to make these things. You're like, okay, you can have the building. How much power are you going to use? And they're like, I don't know. Like, okay, you pay for the power. You're going to pay for the cleanup. You're going to pay for my insurance and your insurance, and you're going to pay for the taxes. And in exchange for all that, I'm going to give you a low rent because I don't want to have to think about it or deal with it because I don't know exactly what you're doing. I own the building, and you're in there operating sort of like you own it. And so those are called pass-throughs, the triple net expenses. So the CAMs, common area maintenance, taxes, and insurance. The reason I like those things for industrial, or those are really great things to have a tenant pay for, especially during an inflationary economy, right? Because those are unpredictable expenses. Like you kind of know what the tax rate is in every market, but taxes can change. The labor costs if you have a property manager that runs the building, that's part of the CAM cost. So labor gets more expensive, and that's an uncontrollable expense. So you can pass that along to the tenant. Insurance, man, insurance is expensive, but it's necessary, and the tenant pays for that too. So it's kind of this really well insulated asset class. So if you're investing in an office building or something else, there's a period of time when a lease starts in an office building, and then it goes on for 5 years, 10 years, whatever. And once that lease stops, then they reset what the expenses are. So that an office tenant has a higher rent because they're paying all of the tax, insurance, property management, all that's included in their rent. So that's why traditionally office rents are higher, is because all that stuff's kicked in. But the difference between office and triple net, usually office is a gross lease, which means it includes all that stuff, is that when the office lease ends, it just hits zero again. So they can renew, the tenant can renew, stay, they get a new rent, which is normal for any asset class. But the expenses also go back to zero, and then they start to accrue over whatever the total cost was at the beginning of their lease. So you don't have any of that. If you model that out, it's crazy how much, you can compare side by side, like a 7 cap, a building that's a 7 cap for an industrial versus a 10 cap for an office, and the 7 cap will still cash flow better if it's a triple net industrial building than a 10 cap office, because of you reset the base year, and you just have to absorb these costs again once the lease renews. So for that reason, I'm a true believer in industrial. Also separate from that, there's a 3% vacancy rate for industrial space across the country. You can look at any market, Miami, you can look at LA, some of the biggest, hottest industrial markets with port cities. You can go to a tertiary market and like off of a highway, major highway anywhere, and there's like 1 to 3% vacancy rate.
Hey, show some love to Dallas too.
Dallas, I mean, I'm picking port cities and coast cities. Yeah, Dallas too. Seriously, any city has a shortage, and that's a byproduct of so many things. One is manufacturing has been coming back to the U.S. Two is e-commerce has been hot for a while. It's cooling off a little. One thing I like to think about is, everyone pretends like Amazon's the canary in the coal mine, but it's not. It's actually Amazon, and they have hundreds of millions of square feet of industrial space. They don't own it all. They lease most of it. They actually just moved into, while they're subleasing some of their spaces, and that hits the news a lot. I think it's 41 buildings that they're putting back on the market, either for sublease or they're just not moving forward with. Most of that's because they don't need it. Their plans have changed. They've been going through what tech companies call hypergrowth for a long time, and so they've got robots doing things that they assume humans are going to do. So when a company puts together a real estate space plan, you want to be efficient, and you want to create an iterable process. You create a process. You say, this is what we do. We get 1 million square feet, and we have space for 500 parking spots, and we need some excess land, and we need it to be 40 feet tall, right? So that's what they do. And they're like, we're going to chunk those out so it's iterable, and we can leverage a lot of vendors, and we get efficiencies through cost savings. But that changes, right? Like robots change things. They don't need as many employees. And because of that, they don't need as much parking. And so they kind of hit the brakes because they're growing a little too fast. But at the same time, they just moved into their largest facility ever about a month ago. Do you like football? You're from Dallas.
I love football. I'm a big Cowboys guy.
Okay, so here's a little football. 4.1 million square feet. That's the size of the newest facility that Amazon just opened. That's 94 acres. Do you know how many football fields that is?
Oh,
It's
I would
94
say
football fields. It's 94
okay.
football fields. Isn't that crazy? Plus or minus, it's like a football field's around an acre. I don't know if it includes the end zones or not, but 94 football fields. Do you want to know what's crazier than that? It's 98 feet tall.
Why is it so tall?
Robots. I mean, if you're thinking about stacking, so like normally with industrial, you're trying to stack things, right? It's a logistics company, and they have all these pallets, and so the reason it's so tall is, could you imagine if you needed, I mean, I don't even know, if you had to vertically 98 feet is like it's a 9-story building, right?
That's massive.
Yeah, could you imagine 94 football fields laid out 9 times, right? That's just in an efficient way to move product, right? So if you stack it vertically, and then you can you can move from one corner down to the other. And so it's just so much more efficient when you've got these robotic systems that can go and grab things based on, pre-programmed data. So it's always fun to talk about Amazon, but at the same time, there's a 3% vacancy rate going on everywhere. There's deglobalization happening and decoupling, where China produces 20% of the world's goods, like they produce 20% of the goods in the world. And they have been for a while. And so, since after World War II, the US, World War II happened, and then the US said, great, we have this amazing Navy, and we're going to patrol the world's seas and ports. We're going to make it so that interstate commerce can happen, make it real easy. And so, that made it so that companies could set up shop in other cheaper territories in other cities and other countries and find cheap labor so that we could, grow the world's economy. So that happened, and it's kind of, at this point, it's flattening out a little bit. It's not as cheap as it was in China anymore. It's not as cheap in India. The fact that back to COVID, we just had a COVID. And so, China's COVID policy is no COVID, right? If there's any COVID, we're going to shut down the country. And, deglobalization just means for a while we were hyper globalizing. We were sending out manufacturing and jobs and all of these things to all these other countries where we could leverage, their resources, their labor, their land. And with deglobalization, it's reining it back in. It's not, it's not going to be extreme, but it's happening. And even incremental is significant, especially when you have a 3% vacancy rate for industrial space, right? Prologis is the largest industrial landlord in the world. It's like over 1 billion square feet. They're called Amazon's landlord, right?
You said who is that?
They've had Prologis.
Oh, Prologis. Okay.
Yeah, they're huge. They've expanded. The rental rates have grown inside of their portfolio over 20% over the last few years, and they project for it to continue to grow. And I mean, they're on an acquisitions tear because they can't build fast enough, so they're just buying up their competition. And the reason is because they see so much yield for these triple net leases, for these industrial leases, because there's so much vacancy. And if there is increased demand for more industrial spaces in the Dallases of the world, and the Dallases and the LAs and the Atlantas and the Floridas, right? Then they're just gonna have more demand and still less supply, and so they can kind of say whatever rent they want. Almost every industrial tenant is a captive tenant, and normally the market's response to that is, okay, let's build more stuff. But guess what? What are interest rates today? I think they're 6%. I don't know when this airs. They could be 10%. We don't know, right? So it's just this really fascinating time to, so an ordinary investor can come in and invest in a syndication or buy an industrial building and actually see some of the benefits of this. And so, that's industrial. Multifamily is great too. I feel like some of those are the best asset classes out there right now. Self-storage, right? Not a lot of people are syndicating industrial product. It's mostly multifamily, self-storage, manufactured housing, things like that.
Passive investors in real estate are able to receive a check every month. Some people call that mailbox money. We say money really does grow on trees. Visit the website at biggerpictureholdings.com, where we have a ton of free resources to help you learn more about planting your very own money tree. It's really cool. So do you see, I guess right now your business plan is raising capital and you are purchasing industrial that's already been built, or are you also in the development process as well?
Yeah, currently I'm mostly focused on buying cash flowing assets that are in place. It's just more efficient and more scalable, and to the point of interest rates being really high. Rents, it's possible to build and still get a high rent, but if you're comparing the built new space to a comparable rent across the street, it's going to have to be really high to absorb the risk of supply chain and labor, and just things take longer. So it's less predictable to do development right now. So I think there are a lot more efficiencies, and I think a lot quicker returns from buying in place real estate. And so I actually set up a system for finding off market properties. That I started doing that earlier this year, and that's worked really well. And I'm targeting Virginia, is where I live, in Charlottesville, Virginia. It's easy to get around and see those. Also Florida, and mostly focused on the East Coast right now. So Virginia and Florida, looking at Ohio next. There's a lot of yield where you can get still really high quality, publicly traded Fortune 500 tenants that need to sign these long-term leases. And the other thing is that the rent grows every year. It's in the commercial lease. It says every single year for 10 years, your rent will increase by whatever is negotiated. Usually it's like 2, 3, 4%. I'm trying to get CPI, the greater of CPI or 3% for one of my properties right now. Right. So if CPI is 8%, then obviously I can at least try to make the argument that that should be passed along to the landlord, and that's fair, right? Because that CPI represents the cost of living.
Yeah. I hope you can get that negotiated in. That would be great.
But we'll see.
So
It was
the
actually
triple
much more common to do CPI leases about 10 years ago, but I feel like they're making a comeback.
That's awesome. So the triple net lease, I mean, I'm very uneducated on that. Is that typically you mentioned 10 years or are they even longer, like 20, 30-year leases?
They're not usually that long. A typical, so it depends on the type of tenant. With industrial buildings and with triple net leases, you can get like 100,000, 300,000 square foot building that has a high quality tenant, and that means a publicly traded company. And those usually don't want to, they don't want to leave. They invest in the infrastructure, and you got to understand that when a company decides on having a facility, especially one that has shipping, receiving, and logistics, one change is hard because you build up all your relationships with all these suppliers. You hire employees. When a company looks at moving offices, they'll do a zip code analysis. Look at the zip code of every single one of their employees, and they'll plot it out to
Seen
figure
those.
out like, yeah, if you move 10 miles one way or 10 miles another way, you can make an educated guess on how many employees you're going to lose. And at a time like this, man, no one wants to lose an employee. Every employee is valuable. So yeah, but to answer your question, usually it's between 5 and 15 years. Yeah,
Okay.
yeah. Set
That's
seven
awesome.
is the normal number, and so you would get an annual escalation on rent beyond that, pass through all the expenses, and then you can renew the lease usually around 12 to 18 months in advance, so that you line up your debt with that.
That's awesome. And so I'm very familiar with, the value add multifamily. What's kind of the business plan for buying industrial? You're not really doing a lot of renovating, you're getting a higher cap rate.
Yeah,
When's the sale period and
yeah,
what does that look like?
it's a great question. So right, so the cap rates for multifamily are low because there's so much value add, right? So you do the analysis and figure out, based on the estimated cost of these repairs, we think we'll be able to move this from a class C to a class B, and then we'll get a higher rent, which will result in higher NOI, and then make it rain, right? And then with industrial, it's not so different, and it's not. I feel like underwriting a multifamily deal is a lot more complicated because it has more variables. The value, there's a couple of answers to industrial. So industrial on the upside, or how to structure the upside. Um, they're companies, they're institutional investors that want to buy long-term safe assets, right? It's just part of your portfolio. So, you know, pension funds, insurance companies that manage billions of dollars, um, Goldman Sachs, right? The companies that manage huge funds on behalf of their investors. They look at, like, they actually have 3, 4, 5 caps, which is the range of cap rate range that you'd see for multifamily. But the reason those cap rates are low is they're kind of like bonds, right? So if you bought a building that Amazon leased and they signed a 15-year triple net lease with Amazon, probably gets 1% annual increases instead of 3 or CPI. You're buying a really stable, safe investment. In fact, you can buy an Amazon bond, or you could buy a building that Amazon leases and get similar or higher return, right? Like a 4 or 5% annual return that escalates every year a little bit. But it's interesting to think about. If you were to buy a bond or if you were to buy the building, you actually get equity with the building. You don't just get the returns, and you get all the tax benefits from doing real estate. Is that your
True.
question?
Yeah, no, you did. Yeah, no, that's super helpful, man. And I really appreciate this. I've learned so much, and I know the listeners will as well. We appreciate having you on, David, and look forward to next time.
All right, great. Thanks a lot.
Like and subscribe below. A new episode will air every Tuesday at 7 a.m. Are you looking for more content? Visit our website, biggerpictureholdings.com. And remember, money really does grow on trees.